Good afternoon, everyone, and thank you to the CFA Society for being here today. My name is John. I'm joined here today by my teammates, Chase, Riley, Spencer, and Zach. Together, we are proud to represent the University of Minnesota. Please join us as we present to you why Sun Country Airlines is cleared for takeoff. We are issuing a buy recommendation on Sun Country Airlines with a 12-month price target of $23, representing 40% upside from yesterday's close. We derive our price target from some of the parts, price to sales multiple, EV to EBITDA, and DCF valuation. Our thesis is supported by three core catalysts and an industry survey of over 60 channel checks with travel agents across the United States focused on Sun Country's primary hubs. The three catalysts we have identified are Sun Country's partnership with Amazon Air, its unique business strategy, and industry-leading profitability. And I'll pass to Chase to go over company background.
Thanks, John. Headquartered in Minneapolis, Minnesota, Sun Country Airlines is a unique, ultra-low-cost carrier that specializes in leisure travel with three distinct segments. First, scheduled service and ancillary, accounting for over 60% of the company's revenue, operating like many other ULCCs. Next, charter, just under 20% of total sales, provides predictable revenue as 74% of its demand is derived from long-term contracts. Lastly, the cargo segment, providing stable revenue year-round through its partnership with Amazon Air. I'll now pass it to Riley to go over our first catalyst.
Thanks, Chase. Our first catalyst is growth within the company's cargo segment, fueled by a contract extension with Amazon Air. Sun Country currently operates 12 aircraft for Amazon Air and is looking to add an additional 8 aircraft into service by the end of August 2025. Growth in this segment will provide Sun Country with further scheduling flexibility while decreasing revenue seasonality with low capital outlays. I'll now pass it to Zach to go over our second catalyst.
Thanks, Riley. Our second catalyst is Sun Country's agile peak demand strategy coupled with projected travel demand. Sun Country focuses its operations on allocating resources to its business segments with the highest anticipated demand by shifting capacity between scheduled service and charter segments. This strategy provides Sun Country with extreme optionality to fly more charter and slow scheduled service periods. Since making the shift back in 2018, Sun Country has grown revenue 84%, resulting in an 11% 6-year CAGR. We believe this strategy is a crucial part of Sun Country's business model and allows them to capitalize on the highest profitability markets. To further understand expectations for leisure travel demand over the next 12 months, we conducted an industry survey with over 60 travel agents across the United States. We also interviewed the landline couple to further understand their partnership with Sun Country and the demand for complementary travel services. Through our proprietary research, we received a consensus bookings growth of 16% over the next 12 months for travel demand. Additionally, numerous travel agents voiced a preference towards Sun Country Airlines, given the airline's lowest flight cancellation rate among ULCCs. We believe projected industry growth will contribute to Sun Country's continued success under their agile peak demand strategy business model. I'll now pass it to Spencer to go over our third catalyst.
Thank you, Zach. Our third catalyst is Sun Country's industry-leading profitability, driven by schedule integration, making sure every single flight is capitalizing on the most efficient opportunities available. When looking at both EBIT and EBITDAR margins, Sun Country is the industry leader, producing 10 consecutive quarters of profitability. Sun Country's unique business model generates high TRASM along with a competitive CASM, producing the largest spread among low-cost competitors. I'll now pass it over to John to go over our industry analysis.
Thank you, Spencer. The airline industry is a highly competitive and low-margin environment where carriers must compete on fair prices to capture market share. The industry has shown strength since COVID and is projected to grow around 5% for the next 2 years. Additionally, we analyzed MSP air traffic data and uncovered that Sun Country has gained operations market share of over 5% over each of the last 5 years, indicating the strength of the company. The airline industry consists of 3 types of carriers: legacy, low cost, and ultra low cost. Legacy carriers offer premium service along with an extensive global hub and spoke route network catered to price agnostic travelers. Low cost carriers utilize a point-to-point model rather than a hub and spoke, achieving similar services while offering lower ticket prices than legacy carriers. Ultra low cost carriers offer the lowest ticket prices offset by ancillary fees such as baggage, seat selection, and onboard food and drink. I'll now pass to Spencer to go over ESG analysis.
Thank you, John. We assigned Sun Country a C+ ESG grade with a score of 78 out of 100. We consider factors such as carbon emissions, block hours, community involvement, diversity, and leadership compensation. The airline industry is not environmentally friendly. However, Sun Country limits total emissions by scheduling significantly less block hours than competitors. Furthermore, the aircraft used in the cargo segment is 20% more fuel efficient than traditional freighters. Addressing the social component, Sun Country has a 7-year relationship with Make-A-Wish Minnesota, providing hundreds of children means to reach their dream destination. Additionally, they are partnered with Starbase Minnesota, a STEM organization, providing pilots to teach flight techniques and aviation technology. Finally, Sun Country offers special benefits and services for U.S. military members and veterans. And CFO Dave Davis both have extensive experience within the airline industry. Compensation for Mr. Bricker and Mr. Davis is largely at risk, aligning shareholder values with their own. Sun Country's board is also extremely diverse, representing a 50-50 split between men and women, including a woman of color, a member of LGBTQ, and a military veteran. I'll now pass it over to Chase to go over our financial analysis.
Thank you, Spencer. Since 2019, Sun Country has generated a 5-year CAGR of 9% while maintaining margins above the industry average. Included in that period is the COVID pandemic, which Sun Country navigated masterfully compared to other peers. The industry average was a near 40% loss, yet Sun Country was almost profitable and generated a 38% 3-year CAGR following the shutdown. We are also forecasting a forward 4-year CAGR of 9% until 2028, with net margin expansion to over 10% in that span. Additionally, we are projecting significant free cash flow growth on the back of the asset-light cargo business, slashing CapEx in half. Moving forward, management has stated that CapEx will be under $100 million for the foreseeable future, which enables the company to deleverage their already clean balance sheet. Now I'll pass it to Riley to go through returns analysis.
Thanks, Chase. Sun Country exhibits superior management efficiency ratios when it's compared to its competitors, with an ROA of 3.3%, an ROE of 9.8%, and an ROIC of 4.9%. Due to the growth in cargo revenue, we expect the company's margins to expand while maintaining its current asset turnover ratio. And finally, our forecasted margin expansion, coupled with balance sheet deleveraging, will drive a higher ROIC. And now, moving on to our valuation analysis. We arrived at a price target of $23, representing an upside of 40%. We used a DCF in EV/EBITDA and a sum of the parts price to sales multiple valuation. These methods were weighted at 25, 25, and 50% respectively. Starting with our DCF, we derived a price target of $29. We utilized an exit multiple of 6 times, calculated WACC of 7.4%, and a 5-year free cash flow CAGR of 11.7%. For our EV/EBITDA valuation, we arrived at a price target of $24 through an assigned multiple of 6 times. This represents the lower end of the multiple's 2-year peak trough. And lastly, we constructed a sum of the parts price to sales multiple to highlight growth in individual revenue segments. We utilized a 0.96 times multiple to arrive at our sum of the parts price target of $20. And now Chase will walk you through our sum of the parts methodology.
Thanks, Riley. We developed a comparable universe of public companies prominent in their respective industries, scheduled service, charter, and cargo, to then establish an average price to sales multiple for each. From there, we adjusted the multiples given our projected growth rates. Incorporating the weight of segment revenues, we arrived at our blended price to sales multiple of 0.96 times to derive our price target of $20. Through these 3 valuation methodologies, we arrived at our final price target of $23, representing 40% upside. Now I'll pass it to Zach to go through our risks.
Thanks, Chase. We have identified 3 central risks associated with our recommendation. The first is an economic slowdown, which would drastically decrease travel demand. Second, an economic slowdown, which would make cargo growth difficult to navigate. And finally, fuel price volatility, as all airlines deal with fuel price fluctuations. We will now make our final descent, landing at our conclusion. We want to reiterate our buy recommendation on Sun Country Airlines with a 12-month price target of $23, representing a 40% upside. This is based on our 3 key catalysts: cargo expansion, the company's unique strategy, and its industry-leading profitability. We'd like to thank the judges, the CFA Society, and everyone else for being here today. We will now like to open it up for any questions.
Okay, so you're on the sell side, and I'm on the buy side. I'm calling in from a hedge fund, the way out. You don't know if I'm buying or selling or if I've got a position already. What are the bears and the short sellers saying?
Yeah, absolutely. So given our bear case, we're looking at possible economic slowdown, maybe a re-acceleration of inflation rates, putting pressure on consumer discretionary spending. And then for our kind of second bear case, a little bit more on the micro side, would be Sun Country does have older airplanes. So the potential for mishaps, maybe engines going out, do increase probability as they get older, and that would be expensive for the company. And then finally, it would be just delays in the cargo aircraft deliveries that are supposed to be by the end of August 2025. If they were supposed to go past, or if they receive past August 2025, then that would be a potential bear case for our situation.
What do you think of their capital structure?
Of their capital structure, yeah, right now it's definitely has a good amount of debt, absolutely. But with the company's projected free cash flow expansion, we are projecting delevering of the balance sheet, and we feel comfortable with that capital structure following that delevering.
When you looked across the various segments of the business, scheduled, cargo, charter, were you able to come up with a way to figure out the profit margins of each one of those segments and how different they might be?
Yeah, so the company breaks out profit margins based on passenger versus cargo. So you can get an operating margin for cargo and passenger, but you cannot really, with great, confidence, break out between ancillary, scheduled service, and charter.
And if you pay attention to Amazon and their freight businesses, they are a constant company in constant change. In more cases than not, they tend to internalize rather than externalize. So how do you get comfortable with the freight business and Amazon over the long term?
Yep, so I mean, just the fact that Sun Country is, locked with Amazon for a long-term contract, that gives us confidence. Overall, for just freighters and demand for cargo, we want to still see, trends in e-commerce picking up and, sustaining. So I think that would also, establish more confidence in our ability, in Sun Country's ability to maintain a profitable cargo business.
Just to add on to that, Sun Country is the only one that flies the narrow body cargo planes for Amazon. So recently, Amazon just got out of a contract with Atlas Air, who used to fly those narrow bodies, and those other two quick jets in ASL Ireland are overseas. So Sun Country will be the only ones flying narrow body planes, which provide flexibility within Amazon's cargo shipments. So that gives us confidence with that as well.
Another quick question about valuation analysis. It's pretty unique. I like it. How do you come about the weights for the three different methodologies? And also, the quick follow-up on the price to sell multiple, you use a lot of comps, but I feel like some of the comps are much bigger. And how do you feel comfortable using, especially UPS, FedEx, as the right multiple?
Yeah, so we wanted to use the sum of the parts really to highlight the different segments and the different growth rates between them, as they are pretty significant. Obviously, the cargo expansion is a big one there. And then as for the multiples, we took an average of the comps. It was kind of hard to find comparables in charter and cargo, just there are not many being a ton of public comparables. And then we kind of adjusted given historical multiples and based on the average comps.
All right, I'm shocked it made it to me before this question, and I'm guessing you guys have anticipated this, but your bear case has 15% upside for a stock whose 52-week low is $8. And so I guess what was the market pricing in at $8, and for an industry that's historically been very economically sensitive, what makes you comfortable that 14% upside is the downside?
Yeah, so we looked at that. Obviously, since the IPO, the stock has pretty much gone, for the most part, down. We believe it bottomed in the summer. A lot of factors influencing that. In 2022, you had interest rates 2024 they had declining growth. 2023 and 2024 was both kind of the worry of the recession coming. And so we think a lot of those headwinds are kind of out of the way now. And from everything we've seen within the company, there's a lot of room for growth. We like what they're doing in terms of management and their vision. So that's kind of how we get there and what our confidence is with that. We just see a lot of the headwinds kind of in the past.
If you were to be able to speak with management and give them a suggestion on what you think they could be doing to better run or unlock more value, what would you say?
Could you repeat the last part of that question, please?
Yeah, if you were speaking with management, CEO, CFO, leadership, and you could give one piece of advice on what you think they could do to better unlock the value for an investor in their stock, what would you say?
Yeah, I think just our first immediate thought would be producing a sustainability report from an investor, especially right now in such an environment where sustainability is important, that producing that and how many carbon emissions they're producing each year and compare that to competitors would be super helpful to provide for investors.
I get it on that. Yeah, kind of adding on to what Riley was talking about, not producing a sustainability report, compared to some of their other ULCCs, you have Legion, Frontier, Spirit, they produce sustainability reports, but in their 10K, Sun Country does list their annual block hours. And what a block hour is basically the time from when the blocks holding the wheels of the plane from moving are taken out, the time it takes off, lands, put back in, that's a block hour. So basically, when the airplane is in operation, less block hours, less fuel consumed, less carbon emissions, less carbon footprint.
Just curious how you guys used the survey data to incorporate it into your forecasts, and then as a chasing question to that, for a company that's very MSP heavy, you use travel agents from all over the country, just how do you factor that part into the analysis as well?
Yeah, so as you can see right here with our map of where we conducted our industry surveys with different travel agents, our primary focus was to get an overall general understanding of where the travel demand was headed for the next 12 months, not just in MSP, but we really wanted to understand the entire United States as, some countries' ultra low cost competitors like Allegiant is focused in Las Vegas, Nevada, and other parts of the world. So we really wanted a good understanding of the entire United States with a heavy focus of being in the Midwest to understand where Sun Country's main business is coming from.
And then to touch on the valuation part, we use management's given guidance for ASMs for each segment, and then for the scheduled service, we just bumped the RASM up a little bit. We're expecting those planes to be full all the time, for them to be able to maybe raise ticket prices with the demand they're seeing. So that's kind of how we baked it into our valuation.
If you were a competitor to Sun Country and you wanted to cut into their customer base, take share from them, what would you do?
So what we've actually been seeing right now too is encroachment in a lot of their most profitable regions of flying, such as the Caribbean. In the most recent earnings call, they did mention this encroachment. However, Sun Country is still flying there just because it is super profitable for them. So that'd be one way of getting into their competitive advantage almost. And then another would just be primarily focused on comparable ticket fare prices